In the 1970s, the average Canadian home cost roughly 3 times the average household income. One steady paycheck could buy a house, raise a family, and still leave a little to set aside. Today, that same ratio has soared past 8 times. And in Vancouver, it can climb beyond 12. Ask yourself the question that should keep every economist in this country awake at night. How did shelter, the most basic human need there is, quietly turn into a luxury asset that defies the ordinary laws of supply and demand? Here is the part nobody wants to say out loud. Even after the recent correction, even after Toronto and the Lower Mainland saw prices slip year over year, the structure underneath is still broken. A dip is not a cure. The national average home still sits near $673,000. In the GTA, the average tips past $1 million, and in the Lower Mainland, it passes $1.2 million. The prices wobbled, but the impossibility stayed exactly where it was because the 8 times problem was never really about last year's interest rate. It was baked into the foundation. Today, we are going to dig into this layer by layer until you can see exactly who built this trap. Start with the myth you have been sold your entire life, that Canada is simply full. We are the second largest country on Earth. Oceans of empty land stretch in every direction. We do not have a land shortage. What we have is a permission crisis. Across the GTA and the Lower Mainland, the overwhelming majority of residential land is frozen behind exclusionary zoning. On most lots, in most neighborhoods, it is quite literally illegal to build anything other than a single detached house, not a duplex, not a fourplex, not a modest apartment block with a corner store tucked underneath. The land is there, the demand is there, the buyers are lined up around the block. The one thing that does not exist is the paperwork that would let anyone actually build the homes ordinary people can afford. We froze the maps decades ago and called it protecting the neighborhood. What we were really protecting was scarcity. We did not run out of space in this country, we ran out of permission. And scarcity, once you engineer it on purpose, is astonishingly profitable for everyone who already owns. Somewhere along the way, the house stopped being a place to live and became a place to park money. Shelter quietly turned into a strategy. Near the 2021 peak, roughly 1 in 5 homes sold in this country went to an investor, not to a family raising kids. And in the condo towers of Toronto, the very segment that is supposed to be the affordable on-ramp for first-time buyers, the investor share climbs toward 2 in 5. Think about what that does to a young couple at an open house. They are no longer bidding against another young couple. They are bidding against a spreadsheet, one that never gets tired, never gets outbid emotionally, and treats their future home as line item number 4 in a portfolio. Now layer on REITs and short-term rentals, and entire residential streets quietly convert into commercial hotels. The CRA sees the rental income, and StatCan sees the ownership data. In some markets, the rent charged in investor-owned buildings has run as much as 25% higher than in comparable buildings. The homeownership rate tells the whole story in one line. It slid from 69% to 66.5% even as prices almost doubled in a single decade. Fewer owners, higher prices. That is not a coincidence. That is the market working exactly as the money designed it to. Now, look at the arithmetic that policymakers keep losing. For years, Canada added people far faster than it added homes. And even now with immigration targets pulled back, the hole we already dug is so deep that to climb out of it, we would need to roughly double our construction capacity. Instead, capacity is going the other way. Housing starts are falling. High interest rates have frozen new projects before the financing even clears. Condominium presales have collapsed, so the towers that were supposed to rise simply do not break ground. A severe shortage of skilled trades means that even fully approved projects cannot find enough hands to pour the concrete and frame the walls. If you follow the 2 lines on the graph, the line for people who need a home and the line for homes that actually get finished, you see they are drifting further apart every single quarter. Here is the cost nobody ever prints on a billboard. Municipalities have quietly learned to balance their own budgets on the backs of new homebuyers through something called development charges. In the city of Toronto, the development charge on a single or semi-detached home reached $137,846. On a family-sized apartment out in Markham, it is over $121,500. That is a tax bolted onto the price before the first brick is laid, before a shovel ever touches the soil, and it did not creep up gently. A little over a decade ago, that same Toronto charge sat near $14,000. It has multiplied many times over since. Every one of those dollars gets passed straight through to the buyer or straight through to the renter. Governments are finally scrambling to cut these fees, and they absolutely should, because for years, we did something quietly outrageous. We told an entire young generation to prepay in full and upfront for the roads, pipes, and parks that previous generations paid off slowly and gently through decades of property taxes. We made the newcomer subsidize the incumbent, and then we wondered why the newcomer could never get in. But zoning and charges only load the gun. Cheap money pulled the trigger. For roughly 2 decades, interest rates sat near the floor. And here is the thing about nearly free money. Buyers do not bid what a house is actually worth. They bid the absolute maximum a bank is willing to lend them. So the price of the home detaches completely from the value of the bricks and quietly re-anchors to the size of the loan. Prices did not soar because the drywall got more precious. They soared because the money got cheaper, and cheap money floods straight into the one asset every single person in the country is desperate to own. The evidence is written all over the national balance sheet. Canadian household debt now sits near 100% of GDP, the highest in the entire G7. Measured against disposable income, Canadians owe well over 175%, far past our peers. In total, that is roughly $3 trillion of household debt. We did not just buy homes, we refinanced our futures to afford our presents, one HELOC and one mortgage renewal at a time. And now, as those low-rate mortgages come up for renewal at much higher rates, the bill for all that cheap money is finally landing on the kitchen table. This is the moment the damage stops being merely financial and becomes genuinely national. Picture a semi-detached home in most of the GTA or most of Greater Vancouver. Not a mansion, not a dream property, but something plain in a neighborhood that is fine but nothing special. It costs roughly $800,000. Now bring in a household earning $115,000 a year, which is by any honest measure a genuinely good income. For them, that ordinary home costs about 7 times what they earn. The math does not simply strain, it does not close at all. So, the young doctor, the engineer, the software developer, the exact people a modern country needs most, sit down, run the numbers once, and quietly book a one-way flight south. In the United States, those same skills buy a house and a real future. Newly built family-sized starter homes are now more than twice as expensive relative to income as they were back in 2004. At the lower end of the market, new home prices have climbed around 265% over 2 decades, while young dual-earner incomes crawled up just 76%. We train these people here at enormous public expense and then we price them clean out of the very cities where their jobs actually are. More than 3/4 of young Canadians now say they would leave their own city just to afford a place to live. That is not a housing statistic, that is a brain drain. And the cruelest part is that we are financing it ourselves. Step all the way back and look at the whole board. Canada has tied up more of its GDP in housing than almost any other developed nation on earth. Our banks, our retirements, our net worth, our entire private sense of having finally made it, all of it now rests on one single asset class staying expensive forever. That is the national gamble. We poured the entire Canadian dream into a foundation priced at 8 times what it should be and told ourselves it was solid because the number on the wall kept going up. But every dollar sunk into an overvalued bedroom is a dollar that never reaches a business, a discovery, a family, or a life. Innovation, mobility, freedom, and the future itself are all being quietly built on sand and sold to us as bedrock. So the real question is no longer whether a Canadian home costs 8 times what it honestly should. The numbers already settled that. The real question is how much longer a nation can keep pretending that sand is stone before the whole thing finally shifts beneath our feet. If you learned something from this video, please like and hit subscribe. See you in the next one.